So what I want to start with is some common types of risk and their associated risk management tools. These common types of risk, these are the kinds of risks, in investing and broader financial planning that we talk about with the retail client. Because these are the kinds of things that we want to make sure that we're educating them on. Because a lot of people, when especially the first time they've done this, or if they've never done this kind of thing with a competent advisor, they've never really been exposed to this, unless they were, a finance major, in college or in graduate school. They may not have seen this kind of thing. So these are the kinds of things that, we want to make sure they understand going into a relationship with them. And this list is by no means exhaustive at all. There are many more types of risks that are involved in investing. These are just a smattering of some of the more important ones. So I'm going to start with some of the risks and describing them, and then talk about how those risks can be mitigated or managed over time. All right, so the first one is probably the most critical one when we're talking about investing, with the retail investors: inflation risk. I'm sure all of you have some knowledge of what inflation risk is. Basically, it's purchasing power risk, right? So if inflation rises and the value of your investment portfolio does not rise, or does not rise as fast, that means that your purchasing power is declining over time, right? So if the rate of return on your investment is lower than the rate of inflation, then during that time period, the ability of you to then use that money to buy goods and services out there in the marketplace is declining. It's basically your money is getting worth less, right? So that's an important point to hammer home to the uninitiated retail investor, because a lot of people will ask, well, why should I take the risk of investing in stocks or bonds or other types of assets? Why don't I just keep my money in cash in the bank? Well, the answer is inflation risk. And although inflation risk has been pretty low for the last 10 years or so since the financial crisis, inflation has averaged for the most part under 2% during that time period, as measured by the Consumer Price Index. In previous years, obviously inflation had been much higher. Think about back in the the 70s and 80s, et cetera, and previous to that, the 90s even. And then now, more recently, this has become a renewed concern, after COVID, right? So although the headline inflation numbers or the consumer price index numbers have not increased substantially, the inflation risk on certain types of goods and services has gone up pretty dramatically. So, and we're seeing the expectation for inflation risk in the future going up pretty dramatically. Actually, one measure of the expectation for future inflation risk is the price or the returns on Treasury inflation protected securities, or TIPS, which is a type of government bond issued by the U.S. Treasury that adjusts with the consumer price index. So that number this year, so in 2020 year to date, is actually, if not the best, one of the best performing asset classes, meaning the returns are very, very high. So what that tells us is that the market is expecting, potentially a dramatic increase in inflation, potentially in the near future. So the risk of inflation is now back on the table, where it really has been laying very low for a decade now. So now this is a renewed conversation that needs to be had with clients. There are ways to manage that risk, which we'll get into in a few minutes. I'm going to go through the risks themselves first, and then talk about how they can potentially be managed. Next risk that we often have to talk about with clients is idiosyncratic or security selection risks. What I mean by this is, idiosyncratic risks is the risk associated with an individual stock or an individual company, right, as opposed to the broader market, right? So The reason we have to talk about this with clients is because a lot of people are still enamored with the old school, approach to investing of, buy one stock or a handful of stocks and just buy and hold them for eternity. And they think they're going to beat the market that way, or they just don't really have any education on, broader diversity, and and don't really have any knowledge of the risks associated. So idiosyncratic risk is the risk associated with security selection or individual securities, right, as opposed to broad asset classes or the market as a whole. Next one, another big topic for retail investors is market volatility. I'm going to talk a lot about this one later on, but market volatility risk is essentially the risks of ups and downs, right, in the value of your investment portfolio, right? So one way that we often talk about this with clients to simplify the concept for them is when we're talking about building a portfolio, a diverse portfolio of stocks and bonds. If you just want to keep it real simple and look at the two asset classes together, stocks and bonds. Bonds typically have lower market volatility, lower price volatility than stocks do. All things being equal on average. There are exceptions to that, but all things being equal on average, if you have more stocks in a portfolio, you're going to have greater market volatility, greater ups and downs. If you have more bonds in a portfolio, you're going to have less volatility relative to the stocks in terms of ups and downs. So a real simple way to discuss this with clients and put things in perspective for them is you talk about a scale of 1 to 10, right? So on a scale of 10 being 100% stocks, right, and with 1 being 100% bonds with the lowest risk, where does your portfolio lie, or where does your recommended portfolio lie? Is it 50-50, in which case you've got basically a 5 on a scale of 10 in terms of the level of risk on the portfolio, or is it a 3 out of 10 where you've got 70% in bonds and 30% in stocks? So that's a real simple way of discussing the potential risks of market volatility. We're going to get into a more in-depth discussion of this later when we get into the modern portfolio theory tools you see down below there. Next thing I want to talk about is market timing. Market timing risks. So market timing risks, can take a variety of different forms, but the most common with the retail investor is the belief that they can time the market in terms that they can determine when to put their cash into the market and when to take it out, right? So that's the most simple version. The most common thing you find is with the retail investor, they believe that it is very easy to do that and that they should do that. So they'll often attempt to call a top on a market or a bottom on a market and decide that what they want to either want to take their money out or put money in, either as a lump sum or in increments. And they're often doing that just based on emotion, and the new analysis on that kind of behavior has shown that it is detrimental to the investor over the long term, right? So in many ways, and sometimes catastrophically detrimental to them. So we'll talk about how to deal with that a little bit as well. And that kind of leads me into the next idea, which is behavioral risk. So behavioral risk, when it comes to the retail investor, is essentially the idea that investors, especially retail investors, but also professional money managers, just about anybody that's any kind of market participant is subject to behavioral risk. We're human beings. We are not perfect, systematized, computerized decision makers. We have foibles and what I would call subjective rationalism that can affect our decision-making processes when it comes to what to do with your investment portfolio. And more often than not, those those foibles, those behavioral risks are detrimental to portfolio decision making as opposed to helpful. As an example, I have a client that I spoke to, not long ago, regarding their portfolio and their concerns over their portfolio and their belief that the market would take a dramatic fall. This was after the and then bull market reconfirmation. So basically, the market in February, as measured by the S&P 500, had dropped about 34%, by March, and then had turned around and regained its prior records by August. Right. So this was after August. This person, called with concerns about the market and said they wanted to move their money to cash or were considering moving their money to cash because of their belief in astrological signs. So, astrological signs, or depend. I don't know what anyone's opinion is on them, but there's no scientific basis that astrological signs are going to help you in your portfolio decision-making process. So, obviously, I had to talk her out of that to some extent. There's some things you can rationalize with people on, but belief systems and things like that are sometimes immovable. You can't necessarily, so you have to find compromises on, which is what we had to do in that particular instance. But behavioral risks are, when you're dealing with human beings, are those are one of the biggest risks to their own portfolios. Whether they know it or not, something you have to actually lay out for them. And there are many different studies on behavioral risks and how detrimental they can be to the growth of a portfolio. Okay, next one, financial systemic risk. And we're going to come back to this a little while also, because this can get a little bit more complex. Financial systemic risk is the risk associated with the infrastructure of the financial system as a whole. All right. So basically, the plumbing, right, of how the financial system works. The financial system is as a whole, you can kind of view as the ecosystem. If you view it as a human body, to use an analogy, the financial system is kind of like this circulatory system, that pumps blood in the form of money through the body, through the financial system. And there can be heart attacks, for example, right? And there can be blood clots and things like this. So the financial system itself is at risk in some cases. A big example of that would have been during the financial crisis, 2008, 2009. Those are things that are often not incorporated in traditional financial modeling, but nevertheless exist. Something that people need to be aware of and often aren't aware of. When someone has an investment portfolio is that they've acquired through, whether they put it together themselves. I'm sorry, one second, please.
You're super choppy. I don't know if you need to get closer to the router or what.
Okay, I've been told that I am moving in and out, that people cannot hear me too well. So I am going to attempt to move to a different spot. So if everyone could just bear with me, and hopefully that will take care of the problem. Everybody take a 2-minute break here. How bad was it? Can you guys hear me at all? Is it? Okay, can everyone see me and hear me a little better now? Yes.
Yeah.
Yes. Yes. Better. Okay. Less choppy. Good. Okay. I'll share my screen and we will continue. Okay. Everybody can see the screen again? Okay. Okay. Where was I? Okay. Fee and expense risks. Fee and expense risks are are risks to the extent that people don't know about them. They didn't know they exist at all, or they don't know how much they're paying, right? When it comes to the costs for the management and maintenance of a portfolio. You know, these fees and expenses can come in many forms. You know, when it comes to traditional brokerage, you're talking about, you know, commissions and trading costs. You're talking about upfront sales charges and back-end sales charges. When it comes to, you know, the investment advisory and asset management, you're talking about investment advisory fees. You're talking about portfolio management fees, and you're talking about internal expense ratios of funds. There's also, you know, custodial costs, like the annual IRA custodial fees, or the fees for comes to retirement plans, the fees for third-party administration, and, you know, various nickel and diming kind of things that you kind of come across. The reality is that when we talk about these things with people, almost always they have little or no idea what they are paying in fees, right? When we talk about new client, when they talk about their existing portfolio, you know, wherever they're at now, right, before we take it over. So one of the things we have to do is go through a pretty rigorous educational process, and, you know, we do an investigation and figure out, you know, what are they actually paying, because many of these costs are actually hidden, right, and intentionally hidden by the financial services industry. All right, that's been the way of doing business for many years. There's a lot more attention on this issue over the last few years, so there's a lot more transparency coming out around this, but it's still, in many cases, a black box, you know, especially to the retail investor who does not know how to do this kind of analysis or interpret, you know, the information they're given. So that is a process we often need to go through with people. So it is a risk in that, you know, it's essentially a behavioral risk in that it's, you know, people don't know how to assess it. Even if the information is there, they do not know how to identify, you know, what those costs are. Okay, similarly, you know, tax risks. All right, tax risks are similar in concept. You know, people don't know what they're paying in taxes. They don't know what their tax liabilities are. This is something that you guys as CPAs are obviously very familiar with. That's what they hire you for, in part, right? So there are all kinds of embedded tax risks in terms of portfolio management and the management of portfolio that can be addressed, right? That can be, and we'll talk about how to address some of those. You guys are pretty familiar with this area, but we'll do a review there as well. Next, longevity risk. Longevity risk, when we're talking to a retail investor, is the risk, effectively, of outliving your investment portfolio, of outliving your income. You know, with expanding, you know, lifespans over the last, you know, 50 plus years in the United States. I think there's been a bit of leveling off of that in the last couple of years, but for many years, you know, people were living longer and longer, and really didn't have a way of hedging for that, right, didn't have a way to make their money last as long as they do. People don't want to be eating dog food in their old age, so you have to find a way to have this discussion with them and have to build into their financial planning and their portfolios a way to make their money last as long as they and their families do, to make sure everybody's comfortable throughout their lives, even at the end. Right. Next thing is mortality risk. Mortality risk is obviously the risk of dying, right, prematurely. So the risk there is more so to the family, right, or to a business, or to any other entity that has an insurable interest in someone continuing to live, right? So the main way that can be addressed is through life insurance. All right, there are other ways to do it as well, but life insurance is a key tool there. All right, morbidity risk, the risk of getting sick, becoming disabled, needing long-term care. These are also things that can be addressed through the use of insurances. All right, so that's kind of these are some of the major risks that we often talk about with the retail client, that these are not things that are necessarily at the top of their mind, or they have ever really been educated on when we first meet with them. In some cases they have. Some cases they've been through training on this. They've worked with other advisors who are competent. They've had education on it. But we find that more often than not, most people need to have these conversations in order to set a framework for the recommendations that we will ultimately make for them. So let's go through. So we talked about some common types of risk, right? But there are also tools to manage those risks, right? And these are some things that we will often recommend, right? Used to address these problems, right? So inflation risk. Well, in the long term, right, inflation has shown historically to be able to be most effectively hedged by a diversified portfolio, primarily composed of stocks and other assets that can beat or track inflation, right? There are more and less conservative ways to attempt to do this. Probably the most conservative way to address inflation risk would be to simply buy individual Treasury inflation protected securities and hold them to maturity. But all that's going to do is basically track the CPI index in terms of and hold the value. It's basically a store of value, right? Other ways to address inflation risk, other stores of value, historically have been things like gold and artwork and things of that nature, things that don't necessarily appreciate in value above the rate of inflation, but will hold value over the long term. Those are some ways of addressing those. Other ways that we more commonly recommend to people to do this is to not just keep pace with inflation, but attempt to outpace it. All right, and the best way to do that historically has been through stocks. Right, to buy publicly, whether it's publicly listed securities or private equity or other alternative investments like real estate, or commodities, for example. A diversified portfolio of these types of assets has proven over the long term to give you the ability to outpace the inflation rate, which is ultimately what everybody wants to do, because we're doing a financial plan for someone and all you're doing is keeping pace with inflation, or if you're not even keeping pace with inflation because you've got too much of an allocation to cash or to short-term bonds, then you basically are swimming upstream, right, to get where you want to go, right? You're swimming against the current. You have to work harder and harder to get to the same place, whereas if you were swimming downstream with a portfolio, diversified portfolio of stocks and other assets, it will be easier and faster to get to where you want to go, although you may need to tolerate greater volatility in your portfolio during that time period. All right, so that's the conversation we often need to have with people. Another common problem that we find there with the inflation risk is that it's not necessarily that the investor is totally committed to having everything they have in cash or short-term bonds. It's usually not the case. Usually they acknowledge that they need some stocks or other types of assets in their portfolio for growth. But the problem is that they simply grasp the concept that they need more, right? They have too much in cash. They need too much of a cash buffer or a bond buffer. And they don't understand that the cash that they keep in the bank, right, should be included and looked at as part of their overall portfolio return. Often they look at the return on their portfolio, and maybe their portfolio of stocks and bonds is only 25% of their total assets, and they're excluding the return on the cash, their huge cash position in bank, which is, might be in just, checking, savings, and CDs, and or potentially some low return real estate, and they don't include that, and they don't understand that that's part of their overall picture. So getting them to understand that is also important in getting them to the point where they can actually outpace inflation, and achieve their their long-term financial goals, such as retirement, right, in the future. Okay, idiosyncratic risk or security selection risk. It's where I mentioned, you often get a lot of people that have, just a small collection of individual stocks, right, that they've, accumulated over the years, maybe in an online brokerage account, or they bought from a traditional stockbroker who sold them on, this is going to be the next Google, that kind of thing. That is idiosyncratic risk, and there's a very easy way to diversify that risk away, which is by simply buying more stocks, right? And I want to differentiate this from buying different types of stocks. That's different. So let's say you're trying to get exposure to an industry, right? And that industry is let's call it tech, right? And you just own Google, right? You only own Google, but you don't own Facebook, you don't own Netflix, you don't own the rest of the FANGs, right? Well, or you don't own any other of these stocks in the technology sector. Well, if your idea was to get exposure to the technology sector, wouldn't it make more sense and reduce your idiosyncratic risk associated with the risk of just Google, right? And move into a variety of other types of tech stocks, so that now you have exposure to the entire tech sector, right? And you don't have the idiosyncratic risks of one stock or just a handful of stocks. All right, so that's security diversification by number, can take care of that type of risk. The next one, market volatility risk, right? You have to go a step further than that, all right? So market volatility is the risk of your portfolio going up and down. Now, let's say you were just in a portfolio of tech stocks. Tech stocks as a whole, as a subclass of the stock assets, are one of the most volatile types of stock assets in terms of ups and downs. So one way you can reduce the market volatility associated with those types of stocks would be to build in more types of stocks, right? And not just more types of stocks, but more types of other assets like bonds, right? Or real estate, or commodities, or hedge funds, or private equity, right? Different types of assets that move in opposing directions or react different to different market stimuli than just the one type of securities you're already invested in, right? So this is the prescription, basically asset class diversification by type of asset. This is the prescription of modern portfolio theory to address market volatility that we're talking about a little while. Another way to address that is through rebalancing of the portfolio, right? Because what happens with rebalancing, for those of you that are not familiar, probably most of you are, but if you're not, let's say you start with a 60-40 portfolio of stocks versus bonds, and your stocks do really well for a period of a couple of years, and now you've got a 70-30 portfolio, right? 70% stocks, 30% bonds. Well, now you've gone through a nice stock run up. The markets are cyclical. They tend to reverse and go in the other direction, right? There are periods when bonds will outperform stocks and stocks will outperform bonds. And so now you've built up this larger component of stocks built up higher risk in your portfolio, and there's greater risk to the market as a whole because we've had a run-up in stocks. So what you want to do to control the risk level of your portfolio is trim off the gains in the stocks, that 10% extra, and put them back in bonds to bring you back into your expected risk level range of, we talked about that scale of 1 to 10 risk, to bring you back to a 6 instead of a 7 in terms of the risk level, the market volatility level. So that's how rebalancing can be used there. Right. Rebalancing is related actually to the next concept, market timing and ways to handle market timing risk. Right. So market timing risk, we talked about that. That's the risk associated with people putting money in and taking money out of the broader market or sectors of the broader market at the wrong time. One really effective way to address this, probably the best way to address this, is by systematically investing and systematically withdrawing money as it is needed, as opposed to pulling out big lump sums of money at specific points in time. Right. So when you systematically, you could think of this as dollar cost averaging, but it's not really the same thing. I'll talk about that in a moment, the reason why it's different. So systematic investing, by our definition, is when you make money, right, and whatever your job is, and you get cash from payroll. Immediately you take that money without letting it sit in cash for an extended period of time, and you put that money to work in your investment portfolio immediately. And you do that systematically every time you get the money, all right, for anything that you don't need to use for your short-term living expenses. All right, so it's money that can be saved for the long term. So that money, and usually that's done on a monthly basis, or in the case of a 401k, that might be on a weekly or semi-monthly basis. And whenever payroll is done, that money would automatically go into the 401k and be invested in the diversified portfolio, whatever portfolio you have in the 401k. Right. Same concept can be done outside of the 401k. Typically, you do that monthly. That could be into a taxable account that's meant for growth, or a 529 plan that's meant for paying for children's college in the future, right? But the main concept is that it's done consistently over equal time periods, right? And it's done or incrementally, as opposed to in large lump sums, right? And by doing incrementally, you're buying at both highs and lows in the market or whatever portfolio you're investing in, so you get an average price over the long term. Problem with doing it in a lump sum is, well, you could get lucky and you could sell at the top of a market, right? Or you could get really unlucky and sell at the bottom of the market and lose a large, chunk of your investment. And there's no real way of telling with consistency when the top or the bottom of the market is going to be. So to mitigate that market timing risk, you go with systematic investing. And the same thing applies on the way out, right? When you're taking withdrawals. When you're taking withdrawals, right, to supplement your income or to pay for your income, your living expenses during retirement, you generally want to do that not in, for example, a lump sum once every year. You want to do it on a monthly basis, right? As your bills are due, not only so you can pay your bills, but also so that you're minimizing market timing risk, right? So your same thing that goes on the way out. When you're taking money out, you're also buying at highs and lows, right? And at the end of the day, then that year, you've given yourself an average price of the market over that time period, as opposed to, a single one-day price. So you're removing to some extent the luck factor, right? And that's important here. That's what a lot of what we're talking about here is about, trying to remove the luck factor and make this more systematized, so it's more consistent over time with all these risks, right? Another with market timing, dollar cost averaging. Dollar cost averaging is a little bit different. A lot of times people get these two concepts confused: systematic investing and dollar cost averaging. All right, so systematic investing, like I said, that's when you get the money from your earnings and you immediately invest it, right, incrementally as you get the money. Dollar cost averaging is a little bit different because what it entails is you already have a large lump sum of cash that is sitting in cash, and you're worried about the market, right, going up or down, right? And as a result of being worried about the market, you choose to say, I am going to put this money to work in the market incrementally over a specific time period. So let's say that time period, is a max of 6 months, or it's a year, or whatever you decide it may be. You decide I'm going to put in, if it's 6 months, you decide I'm going to put in 1/6 of my lump sum of cash into the market each month for the next 6 months, right? So that can be good. It does address market timing risk, but it can work for you and against you, right? In the long term, and where it can work against you is when the market is rising in value, right? And when the market is rising, actually, if you look at history of the markets, if you look at bull and bear markets, and this is not an exact comparison, because there are times when the market declines during the course of a bull market, but without becoming a bear, right? Which is something we just had happen over the last couple of weeks. But just keeping it real simple to give you a broad brush idea, in the period through the end of 2017, from 1950 to 2017, 17% of market history could be considered a bear market, and the other 87 or 83% was considered a bull market. So basically, if you don't do dollar cost averaging, just randomized, right, at any given time, you're going to be making yourself worse off 83% of the time, right? So it has to be that 17% of the time where dollar cost averaging will actually help you and improve your situation, right? So dollar cost averaging is something that we rarely recommend to people, whereas systematic investing is something that we almost always recommend, right? Because you're getting the best of both worlds with that. You don't have your money sitting in cash and getting eaten at by inflation. You get that money going right into the market and doing it on an incremental basis to limit your market timing risk. All right, whereas dollar cost averaging, you have the inflation risk associated, and you also have the opportunity risk of missing out on rising markets during the time period where your assets are in cash. Is there anybody that would like me to differentiate those two a little more, or is that pretty much fully understood by everybody? Just remember, just interject, just turn yourself, unmute yourself, and just talk if you want to interject. Like I said, we got a small group, so no problem. All right. Okay. Next thing, behavioral risks. So behavioral risks are this. What it boils down to is leaving it up to the investor or portfolio manager or any human being, leaving it up to them to make decisions on the fly or with incomplete information, right? And when people make decisions on the fly or with incomplete information, right, those decisions are poor, right? When people make decisions on the fly, they're doing it largely emotionally because they have not had time, or just based on intuition because they have not had time or the information to do an analysis. Or even if they've had lots of time, often they're making decisions based on incomplete info. And humans are humans, and they don't always do everything exactly the same way, right? They do it based on their past experiences. They do it based on their own mood on any given day, or sometimes they might not do it at all because they're on vacation during the time period that analysis needs to be done, right? So these are all behavioral risks. How can you deal with those? Well, one of the best ways to do it is to systematize the investing process, right? Make it rules-based, make it formulaic, make it algorithmic. So it's not dependent on everyday human decision-making, right? It's dependent on long-term, very well thought out rules or formulas or processes that have been determined in advance, right? And that can be used on a daily basis to reanalyze, new data and information as it becomes available in the marketplace, and then implement a portfolio according to a predetermined strategy for the long term, right? thereby eliminating or vastly reducing the negative results associated with emotional decision-making processes. All right, so that's something we actually as a firm focus quite a lot on. We actually do all of our investment portfolio management according to algorithmic processes that we developed internally here. So we're big proponents of that. And I think results show, not just for us, for many other firms that do things that way, that it is a superior way to manage money in most cases. Okay, financial systemic risk and the water balloon model. I'm going to come back to this. I'm actually going to leave this one for last because it's a good segue into something we're going to talk about later. All right, fees and expense risks. One way that you can address this is through regular service reassessments and investment vehicle updates. In terms of regular service reassessments, you need to regularly reanalyze the portfolio to see what costs you're paying, because they do change over time. Sometimes those costs can be changed discretionarily by, for example, the funds that you're investing in. Sometimes they can't be, and you just forget, right? And sometimes technology changes, and the services available to you out in the marketplace get better because of technological changes, because of efficiencies, increases in efficiencies, and you're stuck with this legacy portfolio with these big, built-in costs to it that you kind of forgot about and don't even realize you have better options out there. So it's important to do reassessments on this, regularly, and determine whether there's something better out there for you now. Often there is, and we find that quite a lot now when we do a lot of fee and expense risk analysis when we're talking about analyzing people's existing portfolios for them, and often we find that they are loaded down with these legacy portfolios full of traditional retail share class mutual funds, or traditional brokerage, stock brokerage accounts with high commission transaction costs, and they're paying out the wazoo for something they could be getting for quarter of the price, given improvements in technology and services. So that's an important point. It's one thing that you can truly control, at least to some extent in management of a portfolio. You can't control the markets, you can't control what your stocks or bonds are doing in your portfolio, but what you can control is the fees and expenses in your portfolio. So it's one thing that's one reason people tend to pay a lot of attention to that more recently in the last few years, I'd say, than they had in the past, after having come into that realization. Taxes are similar in that concept. You can do things to mitigate your tax risks. Things like using the appropriate tax deferral tools, like the appropriate tax wrappers. Putting money, making contributions to employer retirement plans, tax deferred investment vehicles like IRAs, SEPs, profit sharing plans, 401ks, defined benefit plans, etc. Using tax loss harvesting. So if let's say you build your portfolio inside, the bulk of your portfolio, your retirement portfolio, inside of a tax deferred vehicle, but there are limits to how much you can contribute to that. So you're going to need some more liquid, taxable, non-tax deferred assets as well. But that doesn't necessarily mean that they have to be inefficient from a tax standpoint. You can do very tax efficient investing, outside of tax deferred vehicles, by doing things like tax loss harvesting, by doing things like using low turnover vehicles, by using things like exchange traded funds, which have greater tax efficiency relative to traditional mutual funds, by incorporating municipal bonds when appropriate as opposed to corporates, by subbing them in when it is appropriate. I have to say, municipal bonds as a valid substitution for corporates have been, their uses have been very limited over the last 10 years because of the yield differential between munis and corporates. The yield differential has been almost nothing. So you've really had to have a very high effective tax rate in order to make sense for it to use muni bonds. even, so that's another thing to consider. Are muni bonds even appropriate for you, or is your after-tax yield even better just by using a corporate, right? That's a simple analysis to do, something we often do with people. Okay, assessing longevity risk, or managing longevity risk. Well, there's a couple ways you can do that. You can do it on, basing your time horizon and building your liquid investment portfolio over a very long term, right? That's one of the most important ways you can do it. And so for when I say that, what I mean is, a lot of the time, people think that as they near retirement, that means when they get to retirement, they should be out of the market. That they should now be in purely fixed income and just or even converted to cash and just live off that cash for the rest of their lives. Well, that's okay if you're 95 years old and you expect to only live to 98, right? But if you retire at 65 and your life expectancy is now 25 to 30 years beyond your retirement date, then you still got inflation as a problem over that time period. And not only that, you're fighting inflation, but you're now fighting the withdrawal rate on your portfolio. So if your withdrawal rate is going to rise as you get older, right? So not just because of retirement, required minimum distributions, but also because your portfolio value is likely to decline if you don't have an appropriate allocated portfolio. So what we want to try to do when we build out a portfolio at the time of retirement for somebody, we want to build it so we want to stress test it to see whether it will last their entire lives for them, or entire expected lifespan, and then beyond that, hopefully, right? Optimally, we want to build it out so that their portfolio is properly allocated, so that they can, if they have $1 million when they start, they can take their withdrawals, pay their taxes on it, pay their fees on it, and to support their living expenses, and still, when they die 30 years later, have their principal, their $1 million, to pass on to their beneficiaries. That's optimal. Not everybody can do that, but some people can, if they properly allocate their portfolio and take appropriate risks within it, right? Meaning ensuring that they have enough stocks really in their portfolio and don't go too heavy on cash and bonds. It's a common problem, right? You do that, and if you do go too heavy on cash and bonds, you are likely to outlive your money. Far more likely, that is, than if you include a portfolio that has growth built into it. All right. So that's one way to keep things liquid. Another way is to use something called annuities, right? So annuities, are you familiar with this, or at least have some cursory understanding of what annuities is? But there are various types of annuities. In concept, an annuity is just a fixed stream of income, right, provided from one source or another. But when we talk about it in the context of the regulatory environment and the financial services industry, annuities are issued by insurance companies, right? Typically, right? Annuities are also in concept can come from the defined benefit pension plan, right? That the fixed income you get out of that at retirement is effectively an annuity, right? But annuity contracts are issued by life insurance companies. An annuity contract can come in various forms. There are fixed deferred annuities that guarantee a specific rate of growth on a tax deferred basis until a predetermined date in the future, at which point you can convert that lump sum into a tax advantaged income stream for life, right? That's the traditional fixed deferred annuity. You also have variable annuities. And by the way, key point what I just said was for life, right? So the thing with annuities is, and what makes them advantageous for addressing longevity risk is, remember, the longevity risk is the risk of outliving your money. When you get an insurance company to agree to pay you an income stream for life, that means for as long as you live. So even if you're even if you live 50 years after you retire, or 100 years, or 1,000 years, right? They're still on the hook by contract to continue to pay you a fixed amount. So you're never going to run out of money, right? So that's one of the main advantages there. One of the main disadvantages to annuities is that often you're either locking up your money, right, for a specific time period, or you're completely giving it up to the insurance company. That lump sum is gone and you can never touch it again. All you do is get this guaranteed of the income in the future, or there are high fees associated with it, like in the case of variable annuities that are going to limit your upside, growth potential. So the key with annuities is to use them at the right type for the right person in the right situation, and not to overuse them, because there are certainly drawbacks to them, right? Does anybody want me to go on any more depth? To go any much more depth is beyond the scope of this conversation. We've actually done entire events just based on annuities. But does anybody want to have any questions about annuities before I move on from that? Remember, just unmute yourself and interject if you need to. Okay, I'll move on. Okay, I already mentioned these next two, mortality risk and morbidity risk. These are easy to deal with in terms of matching the corresponding solution with the risk. Right, mortality risk you can address with a life insurance contract. That's the most common way to do it. All right, so if you have a risk of dying and there's an insurable interest to make sure that, let's say, the person, you have a breadwinner in a family and they're concerned about, their dependents in the event of their own death. Well, there's a perfect way to offset that risk. You buy a life insurance contract that will pay out on your death, so that there is a lump sum injection of cash that can then be used to build out an investment portfolio that will then provide income to the family to pay their living expenses and other costs, possibly for the remainder of their lives. Right? That's one way to use that contract. Obviously, there are many other ways that we've discussed here in prior classes. Another thing we'll do an entire class on. Morbidity risk, the risk of getting sick, effectively, right? Health insurance, long-term disability insurance, short-term disability insurance, long-term care insurance. These are all things that you got to pay out-of-pocket money for them. You got to pay an insurance premium for them, and sometimes that can be hefty. But morbidity risk, if you look at it from a statistical basis, the risk of becoming disabled or getting sick is much higher than the risk of death up to a certain point